Starting with the new essay, essay 320. Name of the essay is Materiality in Planning and Performing an Audit. Now, materiality basically means any information in the financial statement. It has to be in the financial statements, which is of such importance that it could affect the judgment or the decisions taken on the basis of the financial statement by a reasonable person. It could be any information. For example, this is the balance sheet. If it could be an XYZ item on the asset side of the balance sheet, it would be material if, by looking at this, I as a reasonable person, can this can affect my judgment. If I'm a reasonable person, this particular item, if it is able to affect my judgment by just being shown in the balance sheet, or on the other hand, if it is not shown on the balance sheet, then it affects my judgment, or it is shown at an unappropriate amount, then also it affects my judgment. So anything related to this item, its disclosure, its non-disclosure, its misstatement, if it is affecting my judgment as a reasonable person, this will be considered as a material item. So materiality, starting with the definition of materiality. Materiality means particular information in the financial statements. In the financial statement, we can say profit and loss account or the balance sheet is considered to be material if its disclosure, that is, if XYZ is shown in the balance sheet, if its disclosure, or if it is not shown, that is non-disclosure, or if it is shown at an improper value, that is a misstated. If its disclosure, non-disclosure, or misstatement could change the judgment of a reasonable person. Who is relying on this financial statement. So this is known as materiality. So materiality basically depends upon the nature and size of the item. This XYZ is able to affect my judgment only because it is of such an amount or such a nature. For example, if the XYZ asset on the balance sheet is of just 10 rupees in a particular client who is having a turnover of 100 crores, a 10 rupee item cannot be considered to be material. So its size affects the materiality, its nature affects the materiality. For example, we won't see the size of the item if it is an item which is mandatorily to be shown in the balance sheet, mandatorily by the law, because the law requires that particular item should be shown in the balance sheet. So even if it is of a rupee 1, then also it has to be shown. So the nature and the size of the item affects the materiality. So materiality, from now on, I will be using M for this particular essay as a short form of materiality. Materiality depends upon size and nature of the item. Materiality is judged in the light of surrounding circumstances. That is, for example, this XYZ item, as I was taking, and I was saying that, for example, if XYZ item is for rupees 50,000 and the turnover of the company is 100 crores, in that particular case, we won't call even 50,000 to be material, because 100 crores is far more than your 50,000 rupees. But at the same time, if the turnover was just maybe 5 lakh rupees or 6 lakh rupees, in that particular case, even 50,000 is considered to be material. So what the circumstances are, it affects the materiality. So materiality is basically judged in the light of surrounding circumstances. What the circumstances are, it affects the materiality. I would be taking a numerical example also in this later on in a minute or two. Now we have some ways of judging if an item is material or not. If an item or an information is material, I've discussed already 2 or 3. For example, from its size or amount, then the nature of item, then its legality, then we can have a contractual violation. If there was a contract and it has been violated, this is considered to be a material item, a contractual violation. Then it is a bit interesting that a qualitative materiality. For example, transactions with the related parties. If there's inadequate or if there is a not non-disclosure of transactions with the related party or the related party relationships, this is also considered to be materiality, irrespective of any of the above cases, irrespective of its size or amount or the nature of the item, its legality, etc. But if it is with the related party, it on its own becomes a material item. So this is the qualitative nature of the item, that it is related party item. So in the bracket we can say like inadequate or non-disclosure of related party relationship. Now I'm going to discuss some examples to make you better understand this. With the first example, there are two companies, company A and company B. The two companies, company A and company B, I'm having their turnover, I'm having their profit. We can take damages paid. Now see, if the turnover of the company A is rupees 50 lakhs and the profit is 2 lakhs and the damages paid are 1 lakh, and in the company B as well, if the damages paid are 1 lakh, but the turnover in company B is say for example 100 crores and the profit is 12 crores. So these are two cases. The turnover is 50 lakhs and 100 crores, profit is 2 lakhs and 12 crores, but the damages paid are same. So you would have recognized that this, in this particular case, this is a material item, but this is not a material item because it is depending upon the circumstances, it is depending upon the size of the item as well. So and in this particular case, this is material and it require special disclosure because of its size, but this is not material. So we can say this is a kind of judged on the basis of the surrounding circumstances, as I told you earlier. So this is an example of the surrounding. And then we have legality is something you need to know. I'm taking another example for the legality. Rest I guess are easy to understand. Company C. This is altogether separate from these two. This example, company A and B has no relation with company C. Now this is an example to company C. If the turnover of the company is 100 crores, profit of the company is 12 crores, and say for example in this particular case, as per the Companies Act 2013, if the managerial remuneration comes out to be rupees um, 2 lakh, if the managerial remuneration is 2 lakh rupees, and as per the Companies Act 2013, but the company has actually paid an excess of 50,000, that is, it has paid 2,50,000. 50,000 is not at all material if we ignore for the time being this managerial remuneration. 50,000 as per these circumstances is not material. But since it is as per the law that the managerial remuneration is coming out to be 2 lakh or maximum 2 lakh, and you're paying 2,50,000, this is a violation of law. So this item automatically becomes a material item because there is a violation. I hope that you understand this is a symbol of because. Violation or non-compliance of law. That is, there is a violation of law, even of small amount, it may be material. So these are the two examples. I hope you are able to understand the basic meaning of materiality by these. Now we are moving on to another important concept which is known as performance materiality. For this particular case, I have already written down something on performance materiality. Just a second. On performance materiality, I've written a short note. What I want is that you go through this particular paragraph by pausing this video, and then I'll come on to this to explain you this. So you can pause the video right now, and then after reading this and maybe after writing this, I'll explain you the topic. So you can pause the video now. So with the hope that you have paused the video and read everything that I wrote, I'm explaining you this the meaning of performance materiality. For example, This is the class 1 transaction. This is the class 2. This is the accounts, group of accounts A. This is accounts B, and this is the total or the financial statement as a whole. Now see, performance materiality means amounts set by the auditor at less than materiality. So performance materiality and materiality are two different concepts by the this first two lines, that it is an amount set by the auditor at less than materiality. So see, assuming this to be the materiality, these are the this is the materiality level for class 1 transaction, this is the materiality level of class 2 transaction, this is of accounts, so I can here write this is the actual materiality or actual materiality is one and the same thing. This is the line of actual materiality. So performance materiality is set below the actual materiality, so let this be the performance materiality denoted by PM. This is performance materiality. See, performance materiality is the amount set by the auditor at less than materiality for the financial statement as a whole. This is financial statement as a whole, or for level of a level of for particular classes of transaction. This is class one transaction, class two transactions, or account balances or disclosures. So they have been set for these. The performance materiality has been set for these, for the financial statement as a whole or level of particular transaction, class of transaction, account balances or disclosure. Now, why we are doing this? Why we are setting performance materiality before the actual materiality levels? The reason is to reduce the probability that aggregate of uncorrected and undetected misstatement exceeds materiality for the financial statement as a whole. We are reducing the chances that the aggregate of uncorrected and undetected misstatement exceeds materiality. We are reducing this the chances of this kind of situation where our uncorrected or undetected misstatements, that is misstatements, are exceeding materiality. This is not a good situation where our misstatements are exceeding materiality level, because that in that case they become material misstatements. So in order to avoid such circumstances, we are setting them to the materiality before actual materiality. So even if the performance materiality has been crossed, actual materiality won't be crossed. So to reduce the probability that aggregate of uncorrected and undetected misstatement exceeds materiality, so as to avoid such circumstances where misstatements are exceeding materiality for the financial statement as a whole, that is when we take the whole financial statement, this kind of situation does not arise to an appropriately low level. We are reducing the probability of such circumstances to a low level. This is what the purpose of a performance materiality is. So we can go through it. Performance materiality means amount set by the auditor at less than materiality level, that is this, for the financial statement as a whole, or level for particular or a level for particular classes of transactions, account balances or disclosures. The purpose is to reduce the probability that aggregate of uncorrected and undetected misstatement exceeds materiality. We are reducing the probability of such situation where the misstatement exceeds materiality for the financial statement as a whole to an appropriate low level. To an appropriate probability is being reduced to an appropriate low level. This is what performance materiality means. All right, moving on to a small case where we are comparing materiality and audit risk. There's an inverse relationship, first of all, between degree of audit risk, this AR means audit risk, and materiality level. So unfortunately, the later part of the video had some video problems, so I have to re-record that. And if you could do me a favor by in the comment section, you can put a comment which part of the video you liked the most. I mean, the one which in which I was writing down the notes and explaining that alongside, or this part where it would take lesser time, but I mean, all the notes are already written down, and I'll be focusing just on explanation. So in the comment section, I request you to put a comment regarding this. So this time, all the notes are going to be there, and I'm starting from the uh, where we were, materiality and audit risk, right? So this is the next topic. That's not a problem. So when we are comparing materiality and audit risk, we get to know that there's an inverse relationship between materiality and audit risk. See, when you there's a general tendency in the organization, when in an organization there's an employee who has an intention of committing a fraud. If you see that there could be many transactions under which he can commit a fraud, or he can misappropriate cash. So say for example, there are two kinds of transaction in the entity. An entity is having a turnover of 100 crores, and the employee needs money, and he's willing to misappropriate cash by committing a fraud. So there are two kinds of transaction. One with which was in which he was getting 50 crores rupees, the turnover is 100 crores, and the other one where the entity was getting 10,000 rupees. So where do you think that he would be willing to commit a mistake, commit a misappropriation of cash? Definitely 10,000. Why? Because if we commit a fraud in 50 crore rupees, it is easily going to be recognized, because auditor too is going to focus on that particular transaction. Higher value transactions are more taken care of, but the smaller amount of transaction, he might commit a fraud of 1,000 10 times, it might not be detected, but a single fraud of 50 crores is definitely going to be detected. So if the materiality is very high, the item is very material, the audit risk tends to be on a lower side. So we always say that there's an inverse relationship between degree of audit risk and materiality level. Generally, management and employees don't commit fraud in high value items. Moreover, as a general practice, auditor examines high value items in detail. Thus, it is less risky that high value fraud and errors may not be detected. Thus, high materiality level leaves audit risk at a lower degree. Therefore, there is an inverse relationship. Right? It is the same thing which I've explained to you. I've written it down. Now, this standard on auditing gives some requirements of to the auditor. See, when the auditor is planning the audit, he should determine the materiality and performance materiality. I've already explained what performance materiality and materiality are. So, when he's planning the audit, he should determine that this would be my materiality level, this would be my performance materiality level. The second thing the auditor has to do is the as the audit progresses, he should revise the materiality level, because see, when he's going through the audit work, like I mean, he starts the audit work on 1st of April and he has to continue till 31st of March. It is if it is continuous audit, maybe later, even after 31st of March, it is going to continue. So as the audit progresses, he will come across some misstatements, and if there are more misstatements in a particular item, that becomes more riskier. There are more chances that there could be fraud. So perform more additional procedures in that particular area, and you need to change the materiality level. For example, if you are auditing the accounts, and initially when you had made the audit program, you found that you were giving materiality a high materiality to particular areas, and then you found that they don't even require any audit procedures to be applied, etc. So as you go along the audit work, you get to know whether these items need high materiality or low materiality, etc. So you can revise the materiality level as the audit progresses. So when planning, so this is the first part. When planning the audit, this determine materiality and performance materiality. When establishing overall audit strategy, the auditor shall determine the materiality for the financial statement as a whole. That is, for the complete financial statement, the materiality level is 50,000 rupees. So when you are establishing the overall audit strategy, determine the materiality for the financial statement as a whole. And determining materiality is a matter of professional judgment. That is, the auditor is going to decide whether what materiality is going to be. He's going to use his experience, because in the last, if he audited the same client the last time, he would be having some kind of experience that there could be fraud in these things, etc. So I should keep the materiality level at a lower level, and I mean, he would be knowing what areas to audit, what not to audit, etc. So if you would use his professional judgment, that is his experiences, technical knowledge, his skills, etc., while determining the materiality. So then we have a concept of benchmarking. Benchmarking is percentage materiality. That is, when you materiality is like 50,000. I was telling you 50,000 is the materiality. If you talk about benchmarking, you say 1% is materiality. That is, if the total if the expenditure is more than 1% of the total revenue, this means benchmarking. As per Schedule 3 to Companies Act 2013, if your expenditure is more than 1% of your revenue or rupees 1 lakh, whichever is greater, then you need to disclose it separately. See, revenue is 100 crores, for example. 1% of 100 crores is 1 crore or rupees 1 lakh. Whichever is higher, higher is 1 crore. This is the default limit. 1 lakh is always going to be there. 1% of the revenue, that is 1 crore. You compare these two, whichever is higher, higher is 1 crore. So any item which is more than 1 crore rupees needs to be disclosed separately. This is known as benchmarking. This is an example of benchmarking. So the percentage comparison may be used in deciding the materiality of an item. This percentage criteria for determining materiality is known as benchmarking. So this was the first responsibility. So the first requirement of the essay is that when planning the audit, determine materiality. Now the second is, as the audit progress, revise the materiality level. So revision of materiality as the audit progress. So the materiality level may change depending upon experience gained during the audit process. He gained some experience during the audit process and then change the materiality level. Materiality may be different at the time of initial planning from that at the time of evaluating the audit procedure. That is, initial planning is the beginning and the evaluating the audit procedure at the end. Maybe the materiality may be different in both cases, because you keep on revising the materiality as the audit progresses. So this is another requirement of this standard on auditing. Now we have a very interesting case. See, this is starting with an example. This is the financial statement as a whole. We set the materiality for the financial statement as a whole at rupees 50,000. We say that any item which is more than 50,000 is going to be considered material, right? And we are going to perform audit procedure. We're going to examine that, etc. Now, if there is an account balance or a classes of transaction, these are some classes of transaction, and this is a particular account balances. for these classes of transaction, the auditor feels that the materiality should be at a lower level, because the materiality for a whole financial statement is 50,000, but the auditor may assume or may think that for these transactions materiality should be low at lower level. Even an amount of 10,000 may affect the user's decision, so we shall keep it at a lower level. For these account balances, we think that it should be kept at a lower level, we may keep it at a lower level. So this by this case, we're trying to say that even if you are setting the materiality for the whole financial statement, you still have an option to keep it at a lower level for particular classes of transaction, account balances, or disclosures. So let's read it from here. In case one or more particular class of transaction, these classes of transaction, account balances, these account balances, or disclosures for which misstatement of lesser amounts than the materiality of the financial statement as a whole. This materiality for the financial statement as a whole, this is 50,000. Financial statement as a whole, materiality is 50,000. Misstatement of lesser amounts than the 50,000, right? Materiality of the financial statement as a whole. Misstatement of lesser amount than the 50,000 could reasonably be expected to influence the economic decision of users. Even that amount can influence the decision of the users taken on the basis of financial statements. So in this case, what the auditor should do, auditor shall also determine materiality level or levels to be applied to those classes of transactions or account balances, classes of transaction, account balances. That is, he should have a separate materiality levels for these transaction or account balances, because as far as these transaction or account balances are concerned, even a smaller amount of misstatement, you can say, can affect the user's decision on the basis of the financial statements, right? So this was a very small case. Now we move on to the documentation, what the auditor has to document. This is going to be there in almost every standard auditing. That is, at the end of the standard auditing, we need to document what we have done. So the first thing that comes up here, let's see, what documentation shall include the amounts and factors considered in determining them. These amount, that is, first of all, we need to document the amount and what factors led to the determination of that amount. If we are saying 50,000, what led to determining it at 50,000? Materiality for the financial statement as a whole. See, the audit documentation shall include following amounts and factors considered in their determination. Now, what actually we are going to document is materiality for the financial statement as a whole. That is this thing. We are going to document this thing, materiality for the financial statement as a whole, materiality for particular classes of transaction, account balances, or disclosures. That is, we are going to document these 10,000 and 20,000. Performance materiality. That is, we're going to document these performance materialities and any revision of above materiality. That is this thing, revised materiality. If you have made any revision, you need to document that as well. So 4 things which need to be documented: materiality for the financial statement as a whole, for particular classes of transactions or account balance or disclosure, performance materiality, and any revision. These all need to be documented by the auditor. So this sums up my video on essay 320. You may subscribe my channel, like my video. Thank you so much for watching.